Hello, everyone. Welcome to today's Red Fed session on the TSP. And today we're going to have a lot of information actually on the current market. Um, we always begin with kind of a basic overview of the TSP for folks that are joining in that might be new. But I'm not going to spend a lot of time there today because there's so much going on in the market that's affecting your TSP funds that I really want you to know about. And I want to spend the meat of that time talking about the funds themselves, the markets, the bond market, everything that's really kind of affecting your TSP accounts and how you may want to allocate around that. So that's really going to be the meat of today's conversation. So really, give me about 5 to 10 minutes to kind of open up on some of the basic levels of the TSP to get those out of the way, and then we're going to get into the funds themselves. If you have a question, feel free to put those on the Q&A. If you want the recording of this presentation, that will be launched on our YouTube channel. So you'll be able to see a recording there. I'll give you the ability to subscribe and get the notification as soon as we put that on. As well as the slide deck will be available as well to be sent out to you. So those are usually some questions that we get. Now, doing a quick introduction of myself, I've been working with federal employees all my career, right? Spans from 2005 all the way up to 2025. I'm a CFP. I also double up as a chartered federal employee benefits consultant. So I've really been around the block when it's come to federal retirement, and I'm local to the DC area. Attended Towson, finished up in Georgetown, lived in Bethesda for 15 years, and then currently live reside in Virginia. But the idea of Redfin as a whole is it's to really give you the understanding from a federal standpoint, but really give you some outside financial planning strategies to go along with that so that there's a blend between really the internal stuff and the external stuff. And it's coming to you in one format as opposed to, folks that are not well versed on financial planning, maybe i.e. Your benefits folks, or financial planners that are not well versed on federal stuff. So this is a combination of both, and that's really what Fed was designed to do. So let's knock out some basics for the TSP, specifically talking about 2025. Contribution limits have increased. You can contribute $23,500 to your TSP. If you're 50 or over, you can actually contribute an additional 7,500 for a grand total of $31,000 going into your TSP. The TSP allows you to allocate between Roth and traditional. In fact, all of your dollars that are listed right there in the 2025 limits could go all to the Roth. That might be contrary to public opinion there, but it's the truth. You can allocate every single dollar that you want to your Roth TSP. There are no income limits. The outside limits to Roth IRAs don't apply to the Roth TSP, which is how people get confused. So truly, if you wanted to get all 23,500 or 31,000 if you're 50 or over TSP Roth, you can do so. Okay. Additionally, the TSP allows for withdrawals as early as 55 if you separate from service, right? So that kind of bypasses that 10% penalty on normal retirement plans, which give you eligibility as early as 59 and a half. So TSP is special in that case. It allows for loans up to $50,000 as well. Now, TSP went through some changes a few years back that made it a little bit more um, um, flexible in terms of withdrawals. As soon as you hit the age of 59 and a half, if you're still working, you're allowed 4 age-based withdrawals per year. Now, if you separate from service, you get as many as you want. You're able to now choose from you withdrawing from traditional or Roth. Before, you had to get a prorated amount, basically from both sides. They would send you a check from both sides when you requested for a withdrawal. Now, what the TSP has not actually modernized is the ability to withdraw from the funds themselves. That is not something that can be done. So when you request a check from the TSP, let's say when you're in retirement or separated from service, they're going to basically cash out all of your funds proportionately to send you your distribution. From a financial planning perspective, that's flawed. Mainly because if you're in retirement and the markets are down 10-50% like they are right now, or close to that, you probably wouldn't want to be cashing or selling out those funds that have been impacted by that market correction, especially if we went deeper into kind of bear territory on those funds. So you would want to be able to use the funds that had not been impacted, like your G fund or your F fund is actually appreciated through all of this. You'd want to be able to sell those funds off in a market rout or downturn, not pro rata or proportionally across the board. So that's one thing that the Modernization Act did not actually adjust, and there is no talk for that being adjusted. It set forth a minimum requirement age, which is 73 years old, but now actually has 75 as an alternative date. I'll be showing you those ages. So essentially anything that you have in your traditional balances will be required to set a minimum distribution at either 73 or 75. And that only happens from traditional. Roth is excluded from this distribution. And then as a separated participant, you can now request for installment payments or distributions anytime. It doesn't have to just come through open season. So there was an open season for withdrawal request, which is in November. You couldn't change actually your monthly withdrawals when you were in retirement. But now that's been changed by this Modernization Act. So some things have definitely helped folks in terms of withdrawing in retirement, but the inability to choose from the fund that you want in retirement is definitely a hindrance. There are also no state taxes that can be deducted from withdrawals, so that's also a little problematic when you're trying to estimate your state tax payments or taxes from TSP. They don't withhold that from those TSP withdrawals. So those are just a couple. As of right now, also Roth conversions, which are becoming very popular, those are not something that the TSP offers. I'll talk a little bit more Roth in a second, but I want to clear out some of the just kind of the basic stuff on TSP still. So you now have the ability to access this mutual fund window. I don't see a lot of people doing that. It's about $30 per trade, which is rather expensive when it comes to the trade fee. There's an annual fee, there's specific mutual fund fees, but it does give you access to more than 5,000 other funds. The requirements here is that you have to at least have $40,000 in your TSP account. You cannot exceed over 25% of your TSP balance in terms of investing in this mutual fund window. Where this mutual fund window is going to come handy in terms of where we might link this mutual fund window into is the discussion on some of the TSP funds and the concerns around them. The limitations that you have in just 5 funds are starting to approach levels where those could be problematic. I'm going to talk to you about that. And that's where we could consider utilizing the mutual fund window to combat some of the issues that some of the individual C, S, and I funds potentially have. But we'll come back to this here in a second. TSP loans. I want to finish out a point that we brought up. You have the ability to loan money out from the TSP, $50,000, or you can have 2 loans out at the same time up to 100,000. That would be for a primary residence loan, right? Most people do general purpose loans of 5 years. The upside to the TSP loan is that there is no taxes on the withdrawal. There's no penalty if you're under the age of 59 and a half and you're withdrawing. You get assessed an interest rate that's equal to the G fund's rate at the time of application. And more importantly, as you're paying your money back on interest, that money is actually credited to your TSP balance. And therefore, there is no interest actually ever really assessed on your TSP loan. It's more of a formality to call it a loan, but in reality, you're just paying yourself back the principal plus the interest being charged by the TSP. So so really, this is a more efficient way of withdrawing funds from your TSP than outright making withdrawals while you're working, because it avoids that taxation or that penalty hit if you're under the age of 59 and a half. You can also retire with an outstanding loan. That's a new one in the last few years. You can keep the loan active by setting up a monthly payment, right? However, the limit of paying that loan off still applies, right? 5 years or the 15 years for the all purpose or for the house loan, right? So we've got some questions. And Jeanette, Melissa, I see your questions. In order for folks just to kind of get out at a good time frame, I'm going to take the questions at the end. We'll do about 10 to 15 minutes of Q&A. I just want to make sure folks that are on a fixed schedule right here that are doing this in their lunch hour can go ahead and hop out. And I don't want to run short on the information that I'm presenting by taking questions midway through. But I will answer them in the order that you bring them in. So I'm not ignoring them, guys. I'm just going to kind of wait for those. So this is some information about the TSP loan, and it sets up some principles in terms of how you want to withdraw from TSP if you're still working, not separated still, and how you want to do that more efficiently. We recommend TSP loan. Okay. Now, just because they're not charging you interest doesn't mean that this is something you should do for any reason at all. No. You're taking money out of what would have been a growing TSP balance. You're removing that. And that's probably the biggest hit of it all, is that your funds, $50,000, if you take that out as a loan, is no longer growing for those 5 years as you're paying that back because it's been removed. Okay. So keep that in mind. It's not something to abuse. So when we talked about the TSP really solves a lot of issues that really federal retirees face. One is people are living longer. In fact, there's about a 50% chance that someone in the household will live until age 90, given all the increases in health and all the healthcare and all those things, right? The other risk in terms of retirement is inflation. The cost of living adjustment that you all receive on your pensions is designed to essentially give you one minus the inflation rate. And that's problematic. If inflation is going up at 3% and you're only getting a 2% cost of living adjustment on your pension, right? Over the course of 20 years, your pension is going to feel like 20% less. A 30-year retirement, 30% less. So it's not that you're going to have less money on your pension. It's just going to feel like it's less because it's going to lose purchasing power. And that means your dependency on your TSP is going to grow and grow and grow. And that's not even talking about other expenses that may happen late in life, long-term care expenses. This is just flat out a dilution of your purchasing power because of the design of your pension and the essentially -1 the inflation rate on that pension cost of living adjustment. So we promote that folks that do back of the envelope calculations on what they believe they'll be withdrawing from their TSP year one is a flawed method, because truthfully, that's just giving you your first year. Okay, my expenses are $6,000 a month. My pension and social are $4,000 a month. Therefore, I'll need $2,000 from my social, sorry, for my TSP per month. No, that might be first year, but second year, third year, fifth year, 10th year, you're going to need way more than that because of this cost of living adjustment that does not track the inflation rate. The other risks in retirement are market performance, right? Volatility can really spook investors out of their long-term strategy. Not taking enough risk can also be detrimental to keeping up with inflation. So someone that's super spooked, super scared, concerned about the current political environment, right, it can really make that investor deviate from those long-term goals. Now, someone may say, well, Neil, I'm retiring in the next couple months or within the year. Uh, what are you speaking about long term for? Well, is your retirement just a 5 year event, or is it a 25, 30 year event? Because truthfully, you need to invest your money as if you have 30 years in retirement, not 5 years in retirement. So some of this money needs to still be long term, even though if that money is still on risk in some sort of, you know, market fund, you need to consider that all of this money shouldn't be super safe. Some of it should be safe, which is what you're going to utilize in the next 5 to maybe 7 years. But the rest of that needs to go into some organized long-term portfolio that's going to combat the inflationary issues that we just spoke about, right? The TSP also solves some other risks in retirement, which is the risk that Social Security has a benefit reduction, which is not outside of the realms of possibility, right? In fact, we know it's underfunded. We know that if in the year 2034, the fund itself that pays out benefits goes under, there's no more money left in it. About 75% of your benefits would continue to be paid out from folks like myself that are still working. But the other 25% that comes from the actual trust fund would be done. So have you done like a worst case scenario in your retirement estimates that if you had 25% less in Social Security, you would still be okay? And obviously that would have to come from your TSP, right? So that would be even more pressure on the TSP to fund that deficiency in the Social Security benefit. Healthcare costs are rising, right? So these are also other concerns. Your health insurance, a fantastic one. Currently, federal government subsidizes 75%. Don't know if what the future holds of that subsidy, but you guys have a great benefit. You will keep that in retirement. You will have the option to add on Medicare Part B to kind of make this a fully call it wraparound coverage plan, but that also comes at an extra cost. Medicare Part B isn't free, and in fact, it's income based. The more income you have in retirement, you can see higher premiums there. But in addition to that, what's not covered under Medicare Part B or your health insurance plans is any sort of custodial care that comes from end of life type of health issues, right? You need a nurse to come out. You got to go to a nursing home. None of that is covered from that. And those expenses are rising faster than the cost of inflation. They've been doing about 6% a year. Inflation's been around 3%. So this is another area where maybe the TSP comes in. Okay. The last issue that I'll talk about is taxes. Taxes are a serious issue because we are seriously underfunded in terms of our national deficit, and even our current our current call it deficit is still underfunded, right? We are not bringing in enough revenue to pay for our debts, and generally speaking, that turns into higher taxes. Now, it may not be higher taxes now. Maybe I don't want to play political. Maybe the tariffs clear up some of that deficit right now, right? I'm not speculating on that, but in the end, do we truly believe that what is being laid out as a solution right now clears up all of our deficit? I would have to say that it does not. So years later, when the current administration is gone, new administrations come in, do our taxes still stay the same? Or is the federal tax rates of each of those tranches low or high historically? Well, I'll tell you, they're very low. They're historically the lowest tax rates that we've seen pretty much since the brief moment in 1960s when we saw these tax rates. But beyond that, they're the lowest. We're about 4% lower than the historical average in terms of income taxes. So when you start to think about that, you start to think about putting so much of your funds in the traditional TSPs, and you start to think about those monies that need to come out later by a fourth withdrawal in your 70s. What is going to be the tax rate that you ultimately end up paying for that? And was that a smart decision to put everything away pre-tax and pay it later, or should you have been utilizing some Roth plans earlier on to mitigate some of those tax responsibilities at a time frame where you just didn't expect to have them. So we're going to cover that actually in the last segment of today's presentation, right? But before I go into that, I'll talk a few other things about the basics of TSP, and then we're going to go into these TSP funds and talk about what they're doing, what you should be maybe thinking about using, and where we have some of our kind of where we have some of our hangups on some of the funds right now. So TSP matching, super simple chart to show you that, if anybody that kind of just started in the federal government right now that's listening in and you're not doing the 5% match, you got to. You absolutely have to. It literally doubles up your money up to that 5%. You put in 5, you get 5, that's 10% going in. Note, if you over contribute and you actually reach your maximum contribution before the year's up, because the TSP divides its matching by 26 pay periods, you actually would not get all of your match if, let's say, you hit the $23,500 limit if you were under 50 by the 23rd pay period. The 24th, 25th, and 26th pay period, you'd not get that matching agency deposit into your account. So you want to make sure that all of your contributions don't hit the maximum by earlier than that 26 pay period. Okay. You want to make sure that they're equal and they're spread across all 26 so you get all of that match. Now, keep in mind the matching deposit goes into your traditional balance. You put money in the Roth, it's not going to go into your Roth account. Why? Because the government's not in the business of giving you tax-free money, right? They don't pay you tax-free salary. They're not going to give you tax-free contribution matching. So they're just going to siphon that off in your traditional balance, even if you're putting everything into Roth. Okay. So a couple other slides debated whether this should even be in here or not, just because it's so circumstantial how much you should contribute. We get this question a lot. It's really an individual mathematical kind of recommendation on how much you should contribute. It's according to expenses, income, assets, life expectancy, when you plan to retire. But this is a rule of thumb, right? Rule of thumb is the earlier you start, the less you have to contribute as you age, right? Getting started earlier gets that compound interest in. This is a good kind of rule of thumb. If you're in your 30s, you just got started contributing to TSP, it's about 14%, right? As you get further out, then you start having to need more contributions going into that TSP. And lastly, how should you allocate according to your age? Very simple chart, right? The TSP is broken down into stocks and essentially cash or bonds. The TSP now classifies the G fund as cash, right? It used to be classified as a bond. It follows basically some treasury kind of interest, but in the end, it's a safe account, right? Safe fund. The F fund and G fund are notably safer funds because they're considered bonds or cash. The CSNI are considered your stock funds. The later you are in your career, you want to allocate more towards the safe stuff. Don't go overboard though. Remember, there's still a long segment in your retirement that needs some inflation protection. It needs some in the other stock investments. It can't just go all to G on your kind of last year before retirement. We see that a lot. We really encourage not to do that because you're really just kind of setting up just a short-term situation as opposed to a long-term situation, which is retirement. So this is a good rule of thumb. It's very simple. It's not going to be exact to your situation, but it's something for you to follow. If you're deviating far from this chart, you might want to consider kind of coming back to this chart and looking at how old you are, how much did you have in the individual buckets. So let's talk about TSP funds really quick. Okay, this is going to be a decent session on TSP funds. We have a lot to share. Lots going on in your TSP. You've got your 5 major choices. Your G fund, which is essentially a savings account. We have your F fund, which tracks the aggregate bond, US aggregate bond index. We have your C fund, which tracks the S&P 500 market cap weighting. So by market cap weighting, what do I mean by that? Basically, the S&P 500 index default is to weight companies according to their valuations. Well, with the surge in valuations in a lot of the technology names, this fund is heavily skewed towards speculative areas of the market right now. So we're going to talk about the C fund really quickly. The S fund tracks basically a more extended index called the Dow Jones US Completion Index. That Dow Jones US Completion Index is made up of mostly small companies. Okay, small companies in the United States, some of those being mid-cap companies too, but the majority are small companies. For that reason, the S fund tends to be the most volatile, but it tracks this index of the small cap company index called the Dow Jones US Completion Index. The I fund tracks the international markets. MSCI is the brand of the index. EFE stands for Europe, Asia, Far East on the I fund. Okay. And then you have the life cycle funds, which essentially take all 5 of those funds and then set out a target retirement date and then basically maneuver those funds and get more into G fund by the target retirement fund. There's really nothing special that the target retirement funds do. They set up basically a pie and then they dump into G as you get closer to the target retirement fund. And in fact, what the target retirement funds end up being is 74% G fund. So that's their method. They don't go by what's going on in the economy. They don't go by what's going on in interest rates. They don't go the valuation of the market. It's a simple, let's dump to G fund as we get closer to the target retirement fund. Again, nothing intrinsically flawed by that method, but there's nothing also that's robust as a strategic method in terms of allocating that L fund. Okay. So to talk about the TSP funds, what we need to do first is go back in history, right? We need to go back in history on 2 basic measurements. One measurement is going to be performance, and we call that return, right? So we've got returns up on the screen, right here. Now we've got risk on the screen below, okay? Notice the top performing fund in the entire arsenal, 5 fund arsenal that you have, with L funds being the mixture. It's no other than your C fund. It's no secret. The C fund is about 12% over the last 10-year period. It's been an exceptional performing index. Okay. And anyone that bet against the C fund took the wrong bet. Okay. The second best fund on the lineup in terms of performance over the last decade was your S fund. It returned the second best, but it also was your most volatile fund. It zigged and zagged. It had big up years, big down years. And essentially the S fund put out a really nice return, but also put you in a lot of volatility. Okay, so you have some volatility going on in that S fund. Then followed up by the L funds. The L funds basically that's characterized by the L2040 fund. The L2040 fund, 2030 fund, misspoke, had good performance. Basically, put you kind of in the middle of risk, maybe about a 7% rate of return. But that fund dumps more to G. Those funds that return is getting more muted as time goes by here. Followed by iFund. Now, iFund did around 5% a year over the last 10-year period. You could look at that as a decent rate of return, 5%. But when you look at that from a risk standpoint, that fund took a lot of risk to give you a 5% rate of return. That's not necessarily a good risk-adjusted return, right? So the best risk-adjusted return on the board was the C fund, no doubt, okay? Then you follow that up with the F fund and the G fund. F fund did horrible. The F fund really did lousy simply because the F fund went against a really bad backdrop in the last 3 years where interest rates were going up, which meant that bond prices were going down. So in fact, the G fund outperformed the F fund over the last 10 years because of how bad the F fund did. And that's shown right here. The F fund in 2021, and this is how this sheet doesn't go further out than that, did horrible. Yeah, inflation was up 9%. F fund did about 16% down at one point. It was awful for the F fund. Now, folks that crowded into the G fund were able to save themselves from the carnage of the F. But notice the G fund's rate of return over time really hasn't broken out over an inflation adjusted return over the last decade. In fact, has hovered basically around nothing. And that's really where we expect the G fund to hang in. G fund, from an inflation adjusted return standpoint, barely breaks even, right? So even though you're getting a 3 to 4% rate of return on the G fund right now, is that really getting you somewhere? No, it's not, because it doesn't really beat inflation. It's just a holding account, right? A holding bucket. And this is why people are flooding into things like crypto and things like that because of inflation erodes purchasing power. So the G fund at best just keeps that purchasing power equal. It doesn't gain you anything. And for that reason, the fund really needs to be more of a shorter term instrument. Folks that are retiring within the next few years, yeah, G fund makes sense, right? A portion of your portfolio, but not a strong bit of it, especially if you've got 5 to 10 years away from retirement. Now, the F fund is an interesting case. Horrible performance recently, absolute horrible performance, but why? Well, the F fund took huge hits in 22 and 23 because interest rates were tightening. And in fact, there's an inverse relationship when it comes to bond prices and interest rates. As interest rates go up, bond prices actually go down. So we saw some major drops to the F fund in 22, 23 because that was the biggest interest rate hiking campaign that we've seen really in decades. However, what is the setup for the future? Well, the expectation is that the Federal Reserve will begin reducing interest rates. In fact, they already slightly did. They reduced it by a half point at the end of last year. But the expectation going forward is that that interest rate comes down. Now, why wouldn't that interest rate be reduced further if inflation spikes again, right? How could inflation spike again? Well, it could spike again if tariffs are inflationary. It's yet to be seen the effects of tariffs. It's yet to be seen how serious the administration is about prolonged tariffs or whether they're using this as a bargaining chip. It's too early in the cycle to tell, but we believe that interest rates for the time being are at the highest level that we will see here in this hiking campaign. And we believe that at best, interest rates are paused. Maybe they won't be coming down like the market forecasted, but when we see the history of what the F fund has done, when the Fed is at least done raising rates, maybe they're not dropping it, but they're done raising rates. F fund has gone on to have great 12-month track records and 36-month track records. When you look at historical times when the Fed has raised rates and stopped, F fund has been a pretty good performing asset, especially for assets that are considered safe. So when you look at the G or the F fund backdrop, we believe that there's better room to run on the F fund than there is the G fund. Interest rates actually decreasing over time are going to be bad to the G fund and good to the F fund. Interest rates going up are good to the G fund, bad to the F fund. We think we're on the other side of that. So if you held G and no F, good for you on your safer bond, call it cash element of your TSP. But if you're still continuing to do that, we think that roles should reverse. G fund should probably be downweighted. F fund should probably be upticked in that allocation that you're putting in as your kind of guardrails or your safety net of your TSP. So on to the C fund. C fund's been our darling fund. We've been a huge proponent of the C fund. We've been our number one recommendation really for the past decade. Where are we at on the C fund? How do we bet against such a fund that's done so well, 12+% over the last decade? How do we bet against it? Well, we got to look deep inside the C fund and figure out what's it consisted of. What is its valuation compared to history to figure out, is this fund going to take us to the promised land from here, or is it going to let us down? Well, currently, the C fund trades at 22 times earnings. What does that mean? Well, when we look at the stock market as a whole, and we look at the valuation that the market trades on, it trades on what's called price to earnings. When we look at price to earnings, it simply means that we pay this price for this amount of earnings from this stock or this basket of stocks, right? So if we normally pay 16 times earnings, which means we pay $16 for $1 of profit from the stock market, but we're currently trading at 22 times, that means we're paying $22 for $1 profit. That's historically about 25% overvalued for the amount of earnings that the market produces. Now, if the market's earnings continue to increase, then that overvaluation could be warranted. But if the market at any point trips and the earnings projections just don't increase, they stay the same, then the 22 times earnings is too high of a valuation, and that market will likely retreat back to the historical 30-year norm, which is 16 and a half times earnings. That is a 25% correction. That's a bear market. Okay. That's not just even a recession. That's just a correction to get back to the historical mean. Now, if we look at times where recessions took place when markets were at 22 times earnings, where did they end back? Well, they really ended back somewhere in 14 times earnings. That would represent about a 35 to 40% decrease in a recession, right? This was the 2000 dot-com bust. The stock market was trading at above 22 times, actually hit 24 times earnings. It took a multi-year tumble, came back to about a 14 handle, and then we hit a second recession in 08, which sent stocks to about a 10 times earnings. Okay. You don't normally see something like that unless it's a financial crisis. That's a great recession, right? It's the worst since the depression. I would not be in the camp of seeing something like that. Could we get back to at least 16 times earnings? Absolutely. So our concern with the market is the valuation, right? Is that it's just difficult to see the market printing higher highs with these earnings expectations that could be disappointing, right? And if they're disappointing, and the companies that make up the 500 basket don't earn as much as what they were expected to, or they stay flat, they don't decrease, but they stay flat, then we're likely back to a 16 and a half times earnings, which does represent the correction. So when we look at this data over time, stock valuations have been good predictors of long-term returns, right? If we look at when the market is traded at around 21 and a half times earnings, well, if we take a look at all of the time frames, this is from 1999 to now, those years are all over the place, right? You've had times where the market's done great, done bad at 21 times earnings. So over a 1 year time frame, data is all over the place. But when you start to look to a 5-year annualized return, right, it consolidates. And that average rate of return on the market 5 years out isn't really good. It's less than 5%. Why? Because we've usually caught a correction when you get up to 21, 22 times earnings. It's just not a sustainable earnings ratio for the market. Now, folks will argue this time's different. Look at technology, look at AI. It's allowing companies to earn more, and therefore we should pay more. in terms of the price to earnings ratio. However, usually when you hear this time's different, it's not. Okay, so I'm just giving you the data. Do I know exactly what will happen? I don't. I'm just telling you where the S&P 500 is currently valued at compared to historical norms and what typically happens in the S&P. I'll also talk about why we have such a concentrated market. So again, when we talk about the S&P 500, which is your C fund, it uses what's called a market cap allocation weighting method, which means that it will take the companies that have the highest valuation. And again, how does a company get higher valued in the stock market? It's price, right? So if the price is shot up through a roof, it's actually going to get a higher weighting in the basket. And now, because of the higher price in NVIDIA, Tesla, and some of these names, you've got 10 stocks that are actually making up 38% of your C fund. So essentially 40% of your C fund is just in 10 names, right? And the issue with that is it's no longer a diversified index. It's basically a proxy for almost 10 names. And then the 490 names represent 60% of the index. That's a very concerning piece of that C fund. And with so many people utilizing that fund as their number one fund for their TSP, I mean, there are people that are carrying hundreds, if not even $1 million plus in their C fund these days. You've never seen a concentration risk like that. In fact, in the dot-com bubble there, I mean, we got up to about a 25, 26% concentration, but not 38%. So this is a concern, and this is why you're seeing these price to earnings ratios increase past historical norms because of the weighting system that goes into the TSP. So coming full circle, we talked about the TSP mutual fund window. Where we're seeing some better valuation is we're seeing value stocks look cheaper than growth stocks, right? And in fact, if we look at the growth names right now in the market, these are your NVIDIAs, Teslas, right, Microsoft's, Apple's, all those are trading at 21, 29 times earnings, which is what's making the overall market, because of the weighting system, skewed at 22 times. But when we look at the rest of the stocks in there, a lot of those are value names. They trade at 16.8 times earnings, which is more in line with the overall market. So it's not like the whole market is overvalued. It's really just these big names that are pushing these to unrealistic valuation metrics. And they got to hit perfectly for that market to continue chugging forward. If they don't and those earnings drop, this is why you saw a few months ago, or not even a few weeks ago, more than a month, where you saw DeepSeek in China, their AI model was, you know, doing more than NVIDIA at a cheaper cost, and you literally saw the S&P dive. Well, that's because so much is riding on just a small segment of the market to continuing it higher. So what we would recommend is to not ditch your large cap weighting of your TSP, but you got to look for other segments that reside outside of the C fund to maybe carry the weight. Maybe you start looking for that mutual fund window. You start to entertain some large cap value position that are more attractively valued than the S&P 500. You start to look at more equal weight S&P 500 allocations, right? That aren't just attributing all of the weight into 10 companies. So really do your homework here, but there are some attractive value segments of the market, the S&P. You just got to search for that, look for some value positions right now. We feel that that's the more attractive area to own and the more likely prone to bigger pullback areas in the market. Okay. Additionally, that's fun. So S fund can be very volatile. Don't get me wrong. S fund has been more volatile, the most volatile fund in the market, but the S fund is really small cap funds. And when we look at the small cap index, the biggest small cap index is the S&P 600. It's not exactly equal to your S fund, but they're very similar, right? The S fund has 2,000 companies. The S&P 600 is their top 600 companies out of the small cap. But the point that I wanted to show you is that the small cap index is definitely cheaper than the large cap index by a wide margin. So if you look at times where the large cap and small caps deviated in P ratios, there was a big, there's big corrections on large caps where the small cap index was the benefactor of that lopsided weighting. Okay, we're seeing the largest discrepancy between large cap PEs and small cap PEs that we've seen back since the dot-com bust. Again, we don't know how long this trend will be for these higher large cap kind of growth companies carry these big PEs while basically small cap is being neglected, but there is some opportunity there in that small cap index. Now, keep in mind, it is your most volatile index. It has the most volatility when volatility spikes, but right now it is more attractively valued than your large cap positions. Going into iPhone, the PE ratio of the S&P 500 is 21 and a half. We talked about that, right? And the general PE ratio on 30 years has been 16 and a half. The 20-year it's showing here is 16. Okay, great. When you look at the international indexes, the current PE ratio is 13.7, the average is 13. It really, when you talk about the discount you're getting on international versus domestic, we haven't seen this level of discount really in many decades. So US markets are trading at exceptionally high prices compared to what international markets are. Now, there's a lot of other risks on the international markets, right? There's risks of tariffs, there's risks of the war in Ukraine. So there are all these things, and China is going through a downturn. So all these things have led to a very big discount on international, and that could still play out where international underperforms. But for the first time, we're actually seeing some really good opportunities in international. Now, the question is opportunities in the iFund? I don't know. The iFund has really underperformed because it uses the EFA index. Now, the EFA index is an index that comprises hundreds of international companies. And the issue with that is a lot of these bad companies kind of come into that index. Our recommendation is to play international through your mutual fund window or through a mutual fund that filters these bad companies out. You could do way better typically on an international area, okay, than you can on the index. We like US markets on index. We don't love US market or international markets via an index. That typically doesn't play out well for investors. So we like a screening method on that international side, but we really do think international is starting to look a little bit better. So again, that's contrary to the last 10 years, but sometimes the past isn't indicative of the future. You got to pivot. You got to know when those opportunities are coming up. So S funds and I fund looks more attractive. I fund is problematic because of its index type of what it brings in terms of those stocks. But if you can use that mutual fund window for that I fund, now might be the time to do that, as well as that large cap value side. Examining the L funds. So, we like to look at the L funds to kind of show you what those allocations are and just point out some areas that might need some tweaking if you're using an L fund allocation. One is if we look at the L 2030, notice how much money is in the G compared to the F. Now, that was a great allocation for the last couple of years where interest rates were going up. But if we truly believe that the tightening cycle is potentially done, the G fund is going to underperform the F. May we suggest an equal weighting to these two? Okay, as opposed to what's currently going on. Now, this is just using our thinking caps. All right. Next, we're going to see 31% in the C fund, right? 21% in the I. Now, based on valuations, that may not be a bad bet. But again, because the I as an index has underperformed, may we suggest that some of that I comes into S, right? S is really under allocated in those L funds. Or may we suggest some of that 21% going out to a mutual fund window and you buying a good international fund that has been able to actively manage that space a little bit better than the index. Okay. So these are just some suggestions. Just from the outside looking in, these would be the things that I would really take a hard look at if I was investing in your TSP. Now, I'd like to talk a little bit about market volatility, right? We've seen big volatility this year. From the date of this chart, markets were down 10%. Basically, these points in red show you how far markets have dropped and really the corresponding finishing years. So, for instance, in 2009, markets went down 16%, right? Or sorry, 10. Markets went down 16%, but ended up 13% positive. So you've had these years where markets retreated and came back full steam. So on average, markets declined 14% a year. We got down 10% last week. We had Monday and Tuesday, which were good days on the market this week, right? But Friday, the market had closed down 10% down. That is officially correction territory, but it still doesn't get us to our historical 45-year norm of 14% pullbacks. Everyone's gotten used to really cool markets over the last couple of years. COVID obviously was an exception, but 14% is the normal pullback. So, I would say batten down the hatches. I think we're going to get that 14% pullback when this is all said and done. I don't know if you could expect much more than that, right? Without really true recessionary fears. I don't think tariff scares are going to get us there, or the kind of wacky things going on in the federal government that are creating uncertainty. But 14%, absolutely. I'd say brace for further downside as things shake out, but don't let that spook you out of being a participant in the market, okay? Because that is a normal thing to happen. And in fact, if we look at a long-term perspective of even if we were to go into what we call recession bear declines, right? The average decline is 39%, right? That lasts for about 1 year is that decline. And then a quarter later, 1 year later, the average returns have been exceptional, right? So we still would say, hey, even if we face a recession, it's not something that you want to bail out of your long-term strategy on. We truly think, right, bear markets are little glimpses and moments of time compared to, you get a 30-cent, if you look at 1988, you got a 30% pullback, but then an 800% rate of return literally for 12 years after. Like, we're sitting there being so short-sighted, and that's where emotional decisions can really affect those investors and making mistakes when really you shouldn't have made a move at all. Okay. So stay diversified, understand what your risk tolerance is, know what you're invested in, right? It's okay to make some moves within your funds based on valuations, but not just based because you're scared of XYZ happening that may not actually play out that way. Okay. I'm going to finish off with Roth TSP. I got some simple pieces to just kind of discuss on that. This needs to be updated, right? It's 23,500 for 25, right? Not the year 24. And it's a total of 31K if you're 50 years or over. But again, utilize that Roth balance. right? Utilize that Roth balance. You can make changes right there on your employee personnel page. You can contribute all of your funds to Roth if you want to, right? And the reason that we say that is look at the tax outcomes, right? You put in money to your TSP traditional, great, you get a tax deduction. But all of that money is then taxed in the future versus the latter. There's no tax deduction. That money goes in after tax to a Roth, but that money is entirely tax free to you and your beneficiaries in the future. We really think the setup for Roth is positive. You can avoid required minimum distributions as well completely with through your Roth plans. Again, those minimum distributions kick in at age 73 or 75, depending on when you were born, but that's around 5% of your plan, especially if you're on the latter age. Those percentages get bigger every single year. So these are really some things that hit retirees hard. Not only do they make your income spike in retirement in years you would never think that they would. Like, let's say if your withdrawals, which are in orange, leading up to retirement were fairly diminished after your Social Security kicked in at 67. And then all of a sudden, on an income analysis chart, you see a massive jump of that income. It is exceptionally difficult for your tax bracket to handle that if you're taking out $100,000 of a minimum distribution. It's going to be very problematic for your tax bracket. Okay. So lastly, look at these tax rates as they are. You know, you can look at the joint tax bracket at 24% and see how large that is compared to historical norms. And you can really, truly make some decisions on if you should be paying taxes right now or you should be deferring them. We're in the camp. If you're in 24% or less, pay those taxes off. Don't just be prolonging them to the future. And lastly, I'm going to give you our QR code. If you have not had a one-on-one session, would like to address some of these issues, would like to get an analysis or some sort of guidance, we offer a one-on-one session with our financial advisors that are trained in federal employee retirement. We can talk about any of these kind of line items or points of discussion with you at your one-on-one meeting. So we are backed up by about a month and a half, almost 2 months. So if it's something that's priority for you, make sure you either go to our website here or use your iPhone or smartphone, and you can register right there on that website and try to get yourself a calendar spot. So that's really it. All of our YouTube information is right on our channel here. You can sign up for a YouTube session. Sorry, you can sign up for a one-on-one session right here. And then on our YouTube channel, you can join by subscribing to our channel right here. So right now, I'm going to open it up to questions. I'm going to take a 1-minute break for a water break, and then I'm going to come back and open it up to Q&A. So anybody else has any questions, now would be a good time to do that. And I'll give myself 10 seconds. I'll come back, get some water, and we're going to do these Q&A and finish out this section right here. So thank you so much. Sign up for your one-on-one if you haven't, or join us on YouTube for our recording. We'll come back and do those a 15-minute session on those questions. All right, we're back to questions. We've got some great questions that I would just sifted through here. And I want to try to answer these in the way that they were brought in. So first question came in from Jeanette. If I contribute the max 23,500 to Roth TSP, are those funds pre-tax or after tax? Those are pre-tax if they go to Roth TSP. Okay. Melissa, can you make the conversion to a Roth from the traditional TSP outside of the open season? If I didn't make my TSP a Roth during open season, can I do it now? Absolutely. You could start contributing. Says, can you make the conversion to a Roth from the traditional TSP outside of the open season? Yeah, you can divert your contributions to go into TSP Roth at any time. It does not have to be open season, Melissa. Someone asked, how much more do you pay into catch up when you're 50 or over? How is it determined if you do not make that much? Um, well, catch up is $7,500 more. So as long as you got the ability to contribute that $7,500 more, you could put 31,000 in your TSP, and that's the full limit if you're 50 or over. Is it best to take all the funds out in one lump sum or make installments? When you're withdrawing, it's absolutely best to make installments, right? Lump sum can get you into tax issues. If you do lump sums, make sure that you are paying attention to your tax brackets so you're not putting yourself into a higher tax bracket. John, what is covered by Medicare Part B that is not covered in retirement by FHB? Is Medicare B required? What is covered by Medicare Part B that is not covered by, yeah. So John, Medicare Part B is not required, but it is very much promoted. It is told to you as if you are foolish for not getting on Medicare Part B by your folks there in the government. It is something that gives you wraparound coverage when you have both insurance plans. However, it comes at an extra cost. And that cost is determined by your income. And your RMD from your traditional account can really send that Medicare Part B premium high and through the roof when those distributions come out. So you want to look at all of this. Is it worth to get Medicare Part B if you have a big TSP traditional? If you're in the first Medicare bracket or second, we always recommend to get it because the wraparound coverage is a great format of health insurance to have. But if you start paying at the fourth and fifth Medicare bracket, you're paying $500-$600 for Medicare Part B. It may not be worth it. What the federal health insurance will do is they will decrease their coverage down to the Medicare approved amount if you choose to not get Medicare. So essentially, you'll pay a little bit more in retirement for your healthcare, not for the premiums, but for the coverage if you decided not get on Medicare Part B. So that's kind of the penalty, if you will. All right, what is the maximum tax paid Roth contribution? I'm not exactly sure of that question, John, if you can restate that. How do you know if you have met the max match per calendar year? Well, you don't. There's nothing that's telling you that. You got to do the math. You got to literally do the math of the maximum 23,500 divided by 26 pay periods, or 31,000 if you're 50 or over, and that will give you whether you're on track to hit the max or hit the max before the 26 pay period. You actually have to do that math, which is why I had that one slide in there. Melissa, what if one decides to retire before the end of the year? Given the current uncertainty with RIFs, and we spread our TSP contributions over 26 pay periods, should we then change all our contributions before we retire? I wouldn't, because if you don't get RIF and you hit that maximum contribution before the end of the year, you won't get the match. So I know that there's some uncertainty and you might get RIF before that, but I really wouldn't play that game. If you do get a RIF notice, then you could up your ante on your contribution right at that point, but I wouldn't do it without knowing that. Someone asked, do the recommended contribution rates include agency matching? Yes, they do. That's a great question. So basically, the recommended contribution did include the agency match. Mhm. Is it smart to have anything in a lifestyle fund, set it and forget it? Well, I talked to you about the detriments of the life cycle approach. It's not it's not flawed, but it's not the best. So that just would be kind of my 2 cents on it. But it's better than someone that has no clue what they're doing at all, right? So it is really a good fund to use for someone that has no idea, doesn't really want to get into the ins and outs, doesn't care about large cap growth, value, small cap, international, just wants a method to kind of put it in, then I would still recommend that. What is the best fund to invest in should the stock market crash? Do you lose all your funding? Well, the safest fund of all is obviously the G, but it over time doesn't give you any inflation adjusted return. So it's not really going to be a long-term method for you. Unfortunately, all the funds that really make you money over time are going to give you a risk of losing money if the stock market crashes, but you can't let that um, affect your long-term goals. And that's why I showed you that one chart. Yeah, market went down 30%, and there was a corresponding 800% return over 12 years, right? So like you can't just get too wrapped up in these periods where the market retracts. Question, will the amount you put for Roth be excluded for annual limit or 23,500? Or the total of TSP amount plus the Roth should not go over the 23.5? Yeah, it's a total combined contribution limit for either TSP, Roth, or traditional. It's total. So if you do 23,500 to TSP traditional, and that's your max because you're not 50 over, you can't do anything to Roth, right? So it's a total amount in those two types, traditional or Roth, that is subject to that one limitation, not individually. How much does a C fund cost? How is it based on what you bring home to invest in? There's no cost to the C fund. Your contribution limits determine how you can invest and how much you can invest, and then your choice is to do C, S, and I fund, right? Or any of the others, G or I or L funds, right? The great presentation. Sorry I have to drop for a meeting, but I hope the recording will be available. Sure. Join our YouTube family. We'll be posting the YouTube video there. Melissa, can we change which fund we want our money in out of open season? Absolutely. Melissa, you can adjust your TSP allocation at any time. Mike, the P ratio of 21.9 is of January 31st, given the 5 to 10% decrease in the S&P since then. Do you have an estimate of current PEs? Great question, Mike. They've come down a little bit, but they're still in that 21 range. So they've come down from 22 down to like 21 or a little bit beneath that, but they're still pretty high. So it would say to us that if there's further uncertainty, that PE ratio can contract a little bit more, right? To get down to maybe 20, which would probably be more healthier PE, given everything, given the backdrop. Can you discuss a bit more about your statement that you can take a distribution at 55? Yeah, if you separate from service, you can take a distribution as early as 55. But if you separate from service with retirement, right? If you just separate early, then your TSP goes by age 59 and a half. But separation from service because you were able to retire before, you can withdraw as early as 55. Is it possible for current administration to access TSP funds? No, but there is a rule that if the country's running out of money, like there's a um, what do they call it? Basically the debt ceiling limit. B fund is is a place that they can use to fund the federal government you know while they figure out the debt ceiling. The G fund can be used as a funding source for like a few things. One is the government running out of money. Two is like a national war. Basically, they can use it as a piggy bank. But anything they use, they have to refund. That's that's the limit. That I mean, that's the rule there. If you were to have 70% of your TSP in CS&I, what percent of each would you recommend to allocate? Gerda, that's a tough one because there's normally I would say, the C would carry the most amount in there. The I would carry the least. But the valuations of the I look attractive, but the problems of the I index in itself has been the issue with it. You know, you're really at a place where some of these funds are all having their issues, but I would probably put something in the lines of, 40%, uh, 35% C, 25% S, and 10% I, something like that. Uh, how much is a one-on-one fee? So your first session is a complimentary session by Zoom for an hour. Now from there, it'll be, you'll determine whether you need more sessions. We offer packages of sessions and further analysis of your retirement starting at 750, which is a 2 meeting package all the way up to $1,200, which includes an optional third meeting. So it really is dependent on what you want. But those are our fees after the first session. If over age of 65, should one contribute all income to Roth? It's not an age thing, it's a income thing. You got to determine what your income is now versus where it's going in the future, including the required distributions on what went to traditional. If it's determined that it's going to set you in a higher income tax bracket and or Medicare bracket, then the Roth should be a good solution for you, right? So it's not by age, it really is about need. What are the advantages of a rollover in this current environment? Well, you get the option to invest in different assets that have different P ratios, and you don't need to invest in the C fund as a market cap. There's other indexes like the S&P 500 revenue weighted that give you the ability to invest in a different weighting system of the S&P C fund that might be a little bit more, call it, uh, more attractively valued right now and have less of a concentration risk. So those are going to be your advantages in that scenario. You mentioned rather than investing in the S or I directly, it'd be wiser to invest in a mutual fund window. How do you go about doing that? Well, in your employee personnel page, there will be a ability for you to do the mutual fund window. I'm not exactly sure how to pull that off, but um, just go into your either employee personnel page or the TSP. Maybe it's in the TSP site. I haven't actually done this myself, but you have that mutual fund window, which gives you 5,000 mutual fund universe to invest in. Is the L2040 a Roth IRA? I think it's a traditional, but not sure. And the L2030 is a fund. It's not Roth nor traditional. Roth or traditional is the tax setting of your TSP contributions. The funds are how it gets set in the market. They're two completely separate things. Okay. Well, Linda, I lost some money investing. I lost some investing years for 2, 3 years and close to retirement next year. So I invested heavily, 95% in equities to catch up. Is this a wrong strategy? I mean, Belinda, I don't have a crystal ball. I've given you our kind of ideas on the market and whether it's overvalued, undervalued. Like I don't know. Markets can continue to increase when even if they're overvalued, So I have no idea, but I do think that if you're getting close to retirement, you really need to start looking at other diversification strategies than just maybe the TSP. But that's just my 2 cents, right? The TSP funds, as they are, could continue to do well, but there's definitely some inherent risks in them. And the biggest issue I have is that the C fund, which has really been our breadwinner and the primary recommendation for all clients for the last decade, is something that's giving us some concern right now. And so I would normally not hesitate to say, hey, you know, invest the majority of your funds in the C fund. That would be my normal recommendation. But I have a tough time making that recommendation to folks right now based on its valuation compared to historical norms. And can you convert the entire traditional IRA into Roth all at once? I imagine the tax strategy would be very large. You cannot do that, Anne, from the current TSP. You can only convert to a Roth IRA funds that you already put in to an outside Roth IRA at the moment. Now, given 2026, they should be allowing internal Roth conversions, but right now that cannot be done within the TSP. Okay, and you have to be 59 and a half to do an external Roth conversion. Janet, are the funds that I withdraw from TSP Roth after age 60 tax, are the funds that I withdraw from Roth TSP at 60 tax or tax free? They're always tax free. Anything you put into to Roth is tax free as a withdrawal. So as long as I'm not contributing combined $903 from salary debt reduction, math per pay, I'm okay. That's exactly correct. So basically this person did the 23,500 divided by 26, got $900 as a per pay period contribution. And that's exactly how you would go about it. You would just make the calculation on your own and make sure that lines up with the contributions you've already made, right? You want to take that into consideration, but that's exactly how you would do it. Does the TSP differentiate Roth versus traditional allocation? Are they invested separately? No, right? Whatever your allocation is for your overall TSP will set forth the allocation for Roth TSP and traditional TSP. If I anticipated a stock market crash, should I move all of my TSP in C, S, and I to G, not to lose funds? Then after the crash, move G to C because stock prices would be low. I would highly encourage you not to try to time the market. It's almost impossible to do. My recommendation is if you're worried about a stock market crash, to utilize other investment funds and indexes that are more appropriately valued as opposed to trying to time the in and out of a market. Because generally speaking, that is not something that people successfully pull off. How does this tax get calculated in the Roth? How do you know how much taxes you owe? Well, when you contribute to a Roth, you don't owe taxes, right? Taxes come in after tax. But if you're talking about a conversion, then you'd have to do an entire tax estimate to figure out what your estimated taxes would be if you converted, let's say, traditional to Roth dollars. You would utilize your tax bracket. You would want to take into account state taxes. Uh, those are things that a financial planner can help you with, and I would encourage you to do that if you were ever going to do a movement of assets that were already traditional to Roth and paying those taxes off, as it could get a little complicated. All right, looks like most of these questions are done. Is there a minimum amount we need to start the TSP Roth IRA? Remember, the TSP Roth is not an IRA, so don't use that language, right? Because you'll confuse yourself. If you start to think that your TSP is an IRA, then you're going to use the IRA rules for Roth IRAs, rules that pertain to the Roth TSP. And there's so many different rules, meaning there's a much higher contribution limit to the Roth TSP than the Roth IRA. There's no income limitations, which the Roth IRA has. So don't use IRA language with the Roth TSP because they're separate and they're different accounts. And no, there's no minimum, right? You can contribute to your Roth TSP um, as much as you want or up to that maximum. Alrighty. Well, looks like 50 of you stayed for the Q&A. Thank you. Appreciate that. And I think we've hammered out all those questions. So this 20 minutes of Q&A. I think that's at my max level of voice that I have for the day. But I encourage you guys to join our YouTube family. If you don't have a smartphone on you and you want to join our YouTube channel, it's Capital Financial Planners 2015. That's our handle. Just put that in Google, then type the word YouTube. You'll see our channel pop up. Hit subscribe. That's where we'll post all our videos. Not only do we post videos that we do on markets, we do post videos on tax planning, Medicare planning, benefit planning, all of the above, right? So all of those hit our YouTube channel on a weekly basis. All righty. Thank you so much. Appreciate the feedback, guys. Tell some friends about us that missed it. Send them the recording. We always love folks that don't have the access to this because they're not part of, the invitation list that you got this through. There's many folks that just don't get the resources that should be available to them. So feel free to send this out. Appreciate your feedback, guys, and take care. Have a wonderful rest of your evening, and stay tuned to our next presentation. We will be putting that on here in the next couple months, and that should be some more informative information for you guys. All right. Take care. Sounds good, guys.